Yes, so okay, my task today is to talk about cooperative capital units. I'm going to call them CCUs because it's the shorter and easier to say. We're going to look at it in three ways. We're going to look at cooperative capital units. We're going to look at what they are, how they've worked in the past, and how we could possibly make them more accessible. Some folks see the world in a very simple manner. The tax office, for example, when they look at a capital structure, they see debt and they see equity. On debt you can pay deductible interest, and on equity you can pay franked dividends. But for an investor, the world looks a little bit more nuanced. An investor sees a capital structure through the lens of risk-reward. And if you think about it in terms of what happens in the event of a wind-up, you can see how the capital structure kind of breaks down into components where the senior debt holders are the folk that get paid first. Unsecured liabilities, unsecured creditors are the next cab off the rank. Subordinated debt that's subordinated under its terms of issue to any other liabilities of the enterprise is next, and so on down the capital structure till you get to ordinary equity or ordinary shares. And the thing is that, like in the cooperative's perspective, they see the world a bit differently in the sense of cooperatives don't issue ordinary shares, they issue member shares, if we stick with that nomenclature. And member shares, by their nature, are redeemable. So if you are no longer an active member of a cooperative, the cooperative is compelled to redeem your shares. Because they're redeemable, they are classed as unsecured liabilities of the cooperative, and they sit in the debt side of the balance sheet. Now, this has long been viewed as a source of a capital constraint for cooperatives, because cooperatives can't issue ordinary equity to raise capital. The only way they can build an equity buffer is by retaining earnings over time, retaining surplus over time. So this is the problem that CCUs were designed to solve. CCUs were designed to be capital supportive. They're designed to be subordinated to unsecured liabilities. They have effectively three key characteristics. That they can only be redeemed out of capital that is not share capital, and that's, as we defined, share capital sits on the debt side, so they can only be redeemed effectively out of profits or another CCU issue. They must be non-voting. So only, as Robin has pointed out, members vote. It's your membership that gives you the right to vote, and every member has one vote. So CCUs holders have no right to vote at members of ordinary meetings of ordinary shareholders. And they can be issued to non-member investors. So apart from this structure, CCUs can be very flexible, and so they can be actually structured from a tax, accounting and legal perspective, both as debt and as equity. No, you can actually be, I'm getting into esoterics, but you can structure something that's equity from a tax perspective and debt from an accounting perspective. All right, but this flexibility in terms of our risk-reward spectrum means that, they can be very flexible, and so that to talk about CCUs generically can become quite difficult. And so one way to think about this is to look at the two ends of the spectrum. So at one end of the spectrum, we might have development capital. So we have a cooperative that's a startup that has little by the way of a trading record or retained earnings. And so the CCU structure that might be appropriate for this, just using this as an example, might be debt-based. It might be a revenue-based loan that is subordinated debt, so it's still capital supportive. It amortises as a percentage of revenue, may be subject to minimum revenue level. And to avoid acceleration rights, to avoid events that give rise to credit events where there's stress placed on the cooperative, interest might be cumulative. So what we're trying to define there is a structure that would work for a higher risk proposition, if you like, in terms of the underlying operations. At the other end of the spectrum, You've got production capital, the idea that a mature co-op, a co-op with a long trading history and a significant or material equity buffer, may be able to issue securities that have more fixed interest style characteristics. So the mutual equity interests that are mooted to be able to be issued by ADIs at some future point in time will qualify as Tier 1 capital. They'll qualify as Tier 1 capital in the same way as ordinary shares of trading banks qualify as Tier 1 capital from a regulatory perspective. So what we have here is two ends of the spectrum, and CCUs can be structured along the spectrum if you like. So CCUs offer an incredibly flexible form of capital, and they can be issued to non-members, and there's no restrictions on the holding an individual member can have, unlike member shares where you're capped at 20%. I'm not exactly sure what's going on there. And they can be equity, where there's no specific restrictions placed on the types of returns that are provided on them. So they've actually been around for quite some time. New South Wales introduced the legislation to enable them first in the early 90s, and Norco was an early adopter when they issued Norco Capital Units. And the purpose of these was to refinance $10 million worth of bank debt. And so therefore they were structured as debt instruments, so they ranked ahead of member shares but below unsecured liabilities. They, just lost my train of thought, they had 6 and 12-month maturities and were redeemable subject to profits being available as is required under the CCU legislation. They were transferable subject to board approval. And it'd be fair to say that that Norco had a less than satisfactory experience with these capital units. The issue process was difficult, and ultimately they only raised $2 million of their target of $10 million from members. And so this might explain why Norco hasn't used this structure again. Namoi Cotton issued the largest issue of CCUs. There's been 9 in total to date. And this was a $44 million issue on the Australian Stock Exchange of a CCU structured as equity. So it was perpetual, it ranked after member shares, it paid dividends if the board declared dividends, and of course there was no voting rights, although interestingly the stockholders in aggregate had the ability to nominate, initially 2 but became 3 directors to the board of Namoi Cotton. Now, so these traded quite happily on the ASX from 1998 through to the demutualisation of Namoi Cotton at the end of last year. It's been said that the existence of the notes or the stock were contributed to the demutualisation, and it's fair to say that the large capital stockholders lobbied for a number of years for the last number of years prior to demutualisation for demutualisation to occur. Having said that, only members can ever vote on demutualisation. So the real question that always remains is, what is the value proposition for members that they needed to decide upon? And in this case, they decided to demutualise. ORICoop, as Anthony mentioned, we looked to do an issue of CCU for ORICoop late last year. It was ORICoop's mission is to promote organic farming in Australia, and it does this primarily through owning and managing organic farmland. And so the purpose of this particular issue was to enable ORICoop to acquire a property in Victoria. It was structured as equity, permanent capital, to match the intention that ORICoop has to own these properties in perpetuity. And other than that, it was very similar to an MEI, actually, in terms of its structural characteristics. The issue didn't go ahead, principally because of a lack of institutional demand. And there were 2, and interestingly, we tested the demand. We went back to the institutional market with a property trust structure and increased the size to see what the response would be with respect to the underlying organic farm investments. And the response was much more positive. Now, so what this tells us is one of two things, and possibly both, and I think we think it's both, is that one, investors prefer the familiarity of a property trust over the unfamiliarity of a co-op. And two, there's an issue about size. There's an issue about size in terms of investors need a certain size in order to be able to warrant their effort to analyse the underlying risk-reward proposition. So what we have is, where are we, is we've got a really flexible instrument, but it's proven to be hard to issue and it's even harder to find investors. So, having said that, we're not without hope. Investors are basically herd creatures and they like things that are familiar. There's no doubt that, like, if a mutual were to, a large mutual with a long trading history and an already strong balance sheet were to bring an MEI to the market, there's no doubt that after 15 years of being acclimatised to tier one hybrid equity issues by financial institutions, that issue would find support from the investor market. Where we do have a gap is in respect to this development capital, and the development capital, if we think about that, is likely to be smaller issue sizes where the particular issues will need to be structured according to the circumstances under consideration. And so that makes it very difficult for institutional investors to access because of the lack of scale. Now, this problem isn't confined to the cooperatives. It's a problem for private capital, and has been a long-term problem for private capital. So, and the answer that has emerged in the private sector space is with respect to using funds. So like small cap funds, venture capital funds. Venture capital funds have risen to meet this exact need. And so that's what we see as the path forward. If CCUs are to become widely used with respect to development capital, that a co-op development fund can enable both the scale and a recognised investment process that institutional investors can participate in. And notably, this path has been trodden by mutuals already in the sense of smaller ADIs use an SPV, a special purpose vehicle, to aggregate their capital raising for tier two capital. So, I'm going to finish with a call to action. And what our objective is to find out, in order to create this fund, is to find out what the capital needs are of the cooperative sector. And if we can identify the capital needs, then we'll have one half of the problem, and we can work with the institutional investor sector to create the fund that we can see would meet the needs. And so what we're looking to do is, if you're a cooperative looking for capital, or if you know of someone who is, so you want to hop on that link and register your interest. Thank you.